Hope everyone's doing well. Welcome back to another lesson. So today's lesson is going to be the long-awaited market maker models, and we're going to be going over something called SMT, which is the smart money tool. So, before we get into today's lesson, this is going to be quite an extensive one. So, make your notes properly. You might have to go over it more than once, and that's fine. There's a lot of theory in this, right? Every time the phrase or the words market maker come up, we can expect that. And what I wanted to say before we get into it, it's very, very important that everyone properly and deeply understands the theory that I teach, that ICT teaches, and uses that understanding and incorporates it into their own trading. Because what I see with a lot of traders, right, on Twitter, even Telegram group chats, they're very accustomed to understanding patterns, seeing things formulate a certain way and trading them. And of course, people have basic understanding of context narrative, which is good. Everyone should have that. That is, a basic thing, a minimum requirement. But a theoretical understanding of how the algorithm functions and how the markets function is only going to be beneficial to you, right? Just think about it logically. If you have a better education of everything, is it likely that you're going to be a better trader? Yes. I get an argument where people say, oh, people overcomplicate trading when you know too much, analysis paralysis. In my eyes, there's no such thing as knowing too much. There's a thing of doing too much, yes, definitely, but that comes down to refinement of your system. And of course, as I said, I will be making lessons to support that, and I already have made some. But again, the main point I'm trying to make, it's very important we understand theory. If one day you guys are getting questioned, why did you do this? Why did you do that? Why does that work? You should know the answers to those things. It's not, this works, it's my strategy, I tested it. Cool, yeah, you tested it, that's a very good thing, but you should actually know or have some sort of, basic knowledge of the mechanics of the market. And you're going to see why the market maker models, work the way they do and all the theory behind them today. So cool. Let's get into it. So with the market maker models, we have spoken about these, right? From pretty early on in the mentorship actually. So you guys will see me mention the market maker sell model and the market maker buy model, the two models that we have. So today we're going to be speaking about quite a few things, smart money hedging, their positions, major and minor displacement, the framework that market maker models offer, ROBs, which are reclaimed order blocks, and the silver bullet / getting in line, essentially a way to actually trade these models. So let's start with the basics, right? A market maker sell model, well, both of them will always start with consolidation, right? The sell model will have the buy side of the curve first, meaning we have a move to the upside, Then we have the sell side of the curve, and then we have what we say is RTO. RTO is return to origin. The origin is the consolidation. Why? Because that is where the market maker model is starting. The market maker buy model, again, consolidation, but instead we get the sell side of the curve first, that move down, and then the buy side of the curve after. So cool. You guys have probably seen these pictures floating around, somewhere, Twitter, Telegram, wherever. But this is, the typical pictures that ICT himself made to show how the market maker models function. So let's take the buy model to start. Consolidation, sell side of the curve, right? And then down here we get something called a smart money reversal, and then we get the buy side of the curve, right? We get a move. This is the origin. This consolidation, we get a move above it. Sell model, consolidation, buy side of the curve first, and then the sell side of the curve with the RTO, the return to origin. Yes, as you guys can see. Pretty simple here. These pictures, of course, they're an oversimplification, but that's the main components, the main, framework that we're looking at for these market maker models. Cool. So with these market maker models, this is what I want you guys to make a note of. We expect a move into premium or discount accordingly. Now, before I even tell you, you guys should be able to figure out which one does what. The market maker sell model moves up first and then continues down lower in simple terms, right? Right? Buy side first, then sell side. So what's that doing? Offering a move into a premium. Yeah? The market maker buy model does the opposite. It offers a move into the discount. So now the things that I'm listing are criteria. This is what we're looking, to form. We want to see that initial consolidation. That's when, your ears can kind of perk up and you can start thinking, okay, is this going to be a market maker model? And as you can see, as we form it, we see other consolidations on the way. So in these examples, you're seeing a singular consolidation, right? There's no set number of consolidations. This will depend on time, right? If your market maker model plays out, for example, on the daily time frame, you could have 5 consolidations, right? If it plays out on the 1 minute time frame, you might have potentially 8 small consolidations, but it could also be 2. Each market maker model will have the same characteristics, but it will look slightly different, but it's the same mechanism, right? Now, why do we get these consolidations, right? These consolidations happen because smart money are hedging their positions, right? Go over here. So I have one example. We're going to go deeper into this example, right? Of course, this is not very clear. You can consider it, from this consolidation down and then whatever. But I took this because, this is pretty sideways. Of course, we did have this one move. But anyways, consolidation, third consolidation. And then after this, we don't have any, very clear consolidations. We just get that move down, right? Now, smart money, right, in this market maker buy model, what do you think they're trying to do? They are looking to buy. They want to buy this asset, wherever it is, in this example. Now, smart money have so much money, they cannot just click buy, right? They can't just enter the market. So what did they do, right? This was taught in earlier lessons. Smart money buy at discount, sell at premiums. So what did they do, right? What did these market makers do? They push the price into a discount, right? And then we have that buy side move. So first we have the sell side of the curve. Why? Because smart money are accumulating positions, going down into the discount. That's when we get a smart money reversal. And then of course we have the buy side of the curve. Now this is how I want you guys to look at it. On this side of the market maker buy model, smart money are putting in their buy positions, right? This is where they're putting their buy positions in. And then on this side is where they'll be taking profit, right? They'll be adding to their positions and they'll be taking profit. Now, why? Why does this happen, right? As I said, smart money have a lot of money, right? Very large amounts. They're able to move the market. However, it doesn't matter how much money you have, right? You still need a counterparty. You can't drop, for example, let's just say you have 100k, right? You want to buy 100k worth of DXY. If no one's selling that, can you buy it? Can you buy an asset if no one's selling it? No. So what do they have to do? They have to spread their positions. So now let's go back to that point. Major displacement and minor displacement, right? Make a note of this. Minor displacement will create retracements. Major displacement will be found at reversals, right? That's very important. Now, both those forms of displacement, when we talk about displacement, we say it's a signature of smart money's participation in the market, right? So cool. Let's look at an example. Now, consolidation. And what you typically see is a move up, then a move lower. Same here. This one's a pretty clean one. You get that consolidation. You see, we have this final move up, then we're getting this move lower. Smart money, right? Where do you think they're adding their positions? Where are they putting their buys in? they're putting their buys in when these bullish order blocks are created. They're driving price, that final push up. They're giving price that push up and then letting it drop. That is a minor displacement, right? The small retracement that occurs for price to go higher, and then it will carry on in that direction that it was intended to go originally. So cool. Smart money hedge their positions is the main point of all of that. They come into the market, they spread their positions out. This is why we get all these consolidations, especially on a higher time frame. You get several consolidations, and what they're doing essentially is just building up one big position. Overall, they know they want to go, they want to buy this asset, whatever it is. So what they're doing, they're putting buys here, some buys here, some buys here, because what do they have to do? So think about it, right? If I come into a market, is it easy to find a lot of millionaires? Right? I'm not talking about trading, just generally, right? Is it easy to find a lot of millionaires? No, that's not a common thing, right? Is it easy to find somebody with $100? Probably, a lot of people will have that, So think of it like that. Smart money are coming in, and it's very easy for them to find counterparties by spreading out their positions. Oh, we're going to buy here. So it's easy to find some sellers here, find some sellers here, find some sellers here. Okay, cool. Now we're done. We're in a discount. We're ready to reverse. Smart money reversal. And then, of course, you can see usually the second half of market maker models are very, very quick, very sharp. And that is what you like to see. That in itself is a sign of smart money participation in the markets. So realize that first half is a hedge. And then the second half, in essence, is a distribution, So cool. Now going back to these points, right? So I spoke about the reclaimed order books very briefly there. We'll get back into them in a second, right? Now I'm going to quickly talk about the smart money reversal, the silver bullet, and getting in line. So let's open the charts. Okay, so this is the example I just showed you guys, a second ago. Now let's talk about, in essence, the framework. Start quickly, because that's quite basic, right? If you have a market maker buy model that's about to play out, what happens, right? You're anticipating that smart money reversal, this reversal down here. Once that reversal happens, what becomes easy? It becomes very easy to know what price is now targeting, right? In a smart money reversal, in a market maker model, that final step is an RTO, the return to origin. So price is going to push up. And you have a very, very clear idea of where price is going to go. And of course, as we expect here, price does deliver, right? Moves all the way up. This day in specific, I'm pretty sure I called it in chat. I said Euro USD and DXY had, market maker models playing out. For me, that's personally one of my favorite models. When I see market maker models on DXY and EU at the same time, or DXY and GU, whichever way, and when they line up pretty well, I'm very, very confident on those trades. I like pyramiding positions. I'll get into that in a second. So cool. Now you have that framework built for you. It's very easy to trade these. So how do we get in line with these, right? How do we actually trade market maker models? Cool. So in this side of the curve, we're not really looking to get involved. We're not, unless it's a higher time frame, we're not looking to get involved. With our smart money reversals, we expect them at logical places, right? We expect price to take some sort of liquidity, usually, and we expect it at a high time frame array, right? The biggest thing I would say is logic. Understand when and where, of course, right? For price, when are things happening? Down here, we could have swept, for example, previous weekly low, and now price has a reversal. Is that a place that we typically expect reversal? Yes, it is. So it's logical, right? As you guys can see, we get this displacement, right? So this is now major displacement, because what did it do? Caused a reversal, right? And you see we get that, displacement, we get retracement into fair value gap, and then price moves off. So how could you have traded this? In market maker models, when we get that reversal, what I look for, right, is a move down into fair value gaps. I'm not too interested in the other arrays typically. I just pay attention to my fair value gaps and I expect a move into them, then a move off. So over here, what could we have done? How could we have traded this? You know that there's a fair value gap here and here. These two candles in specific, that's where my attention would have been. We can go on a lower time frame and wait for a 1 minute swing to form and market enter. When price forms this swing low, remember that 3-bar pattern, candle, middle candle is lower, next candle is higher, you form a swing low, right? So this could have been a decent place to market enter, pretty close to equilibrium as well. Cool. That was the first range. Let's assume you didn't get into that, because price didn't come to the discount. The second range price forms is actually this. And now I want you to notice again, what does price do? Price rebalances, right, into this fair value gap and then moves off. And then again, we create a very small range from this low to that high. If you want to count it, retracement down. Now, where am I getting with this, right? With your market maker models, when we're trading that buy side of the curve and the sell side of the curve in the market maker sell models, pay attention to your fair value gaps. Price very rapidly will rebalance and then move off. Even this candle itself, sign of displacement, rebalance, move off, right? Move away. And in general, the market maker model, this example, you guys can see very, very strong move up generally. From this point to that point, versus from here to there, you guys can see this is, pretty much uphill. It's on an incline. So that is the side of the curve that we're attempting to trade. And now the next thing I would like to introduce is the reclaimed order blocks. As I explained, right, these are going to be, so this is, let me just get rid of this. Let's get rid of these for a second. Now, before, right, I explained minor displacement. What is price doing? Price pushes down, pushes up, then carries on in this direction. This push down here is where I want you to pay attention. These two candles, right? These are bullish order blocks, right? Bullish order blocks being created. Let's line these up. They're the final order blocks, before the move away. Same here. We can consider these two, or potentially, we can go with these 3 down close candles, because they're the last 3 candles. Then you get this move up, then you get that, that move down. And over here, you have similar, but I'm not really going to mark this one up because price, traded away. Now, there's 2 main things I want you to notice, right? Price, in a way, respects these areas, You see price finding some sort of support at these areas, especially this one's quite clean. Price trades through, and of course we get a reaction later on, trade back into them, and then we move off. What are these reclaimed order blocks? They're another sign of smart money's participation in the market, because why? This is where smart money were buying, right? Smart money were buying, and then we get that minor displacement that's caused, and then of course they sell off. So what are they doing here? They're actually adding to their positions. This is why price finds a support at these areas, and then of course we deliver liquidity. When we say deliver liquidity, right, guys, in a way, right, you can start looking at it as smart money. They're entering their positions on this side and they're taking profit on this side, right? They're getting out the market on this side. This is where they're exiting, because now they have all these buys. What do they have to pair their buys with? The sellers, right? Or vice versa. So start looking at it like that. That's the mechanism of the markets, right? Buy side delivered to sell side delivered to buy side. What do we call that? Offsetting, accumulation or distribution, right? Start to understand that. So we get these reclaimed order blocks, which are, very important, and they're a sign of smart money's participation. So the last thing I'll be quickly touching on now is the silver bullet, and I already spoke about getting in line with the market maker models, but I wanted to leave the silver bullet to the side because it's a model that ICT has created. And in his words, he says, essentially he says 100% of the time it wins, but that's not how things work. Nothing works 100% of the time, but essentially what he's saying, he's very confident in taking that trade. Cool. Let me just delete this. What he's saying is that second leg of the market maker model, right, will typically offer you a good retracement. Now, in this one, we can consider the first leg from here to potentially this high. As you guys can see, we're offered a good retracement into the fair value gap down here and then the move away, right? Fair enough. You could consider the second leg from here to this high. And what happens again? We get a move into the discount. Now, why did my range change? Because initially I was using this range, right? Like that. And now I'm using this range. So to clarify, the reason it's changing is because this move here, these 3 up candles, then 1 final candle before you retrace, can be what? It can be a lower time frame market structure shift. Now, I'm going to check and I'm going to confirm with you guys, but I'm not going to change the time frame now because it will reset everything and then I have to scroll back for ages. But essentially, this is a market structure shift. We're getting that, initial retracement to the discount, giving us a buy, and then the second leg, you guys can see from here to here, we get this move up, then we get this nice retracement into the discount, into a fair value gap, and then we get that move away. This is where I would have looked to get into the market. So, potentially you could have just lined your trade up at equilibrium, if that's what you want. Market maker models, I'm not too bothered about getting precise entries because I typically hold my, trades quite far. I will not always hold my trades to the origin. So I won't always hold it to up here, right? You could, depending on the time frame. Like, for example, if it's a 1 minute, 3 minute market maker model, then yeah, sometimes I consider it. But usually, as usual, I will target some sort of liquidity. And in the market maker models, that's quite easy to do because you can pair your take profit with one of the consolidations. You can target this consolidation, easy, 1R, target this one, 2.4. And if you really wanted to, you could have held it all the way. And of course, it would have ran you to about 1 to 4R. And earlier, I spoke about pyramiding. What I mean by that is, so this would have been position 1 that I've entered now, right? So what can I wait for? I can see price creates a swing from here to there. What do I wait for? Retracement to what? A fair value gap. Given here, you could enter another position here, right? That gives you another chance again. Now I would have had 2 positions. And on the next positions, right? So the initial position, I will enter with, my normal 1% risk. On my next one, I may enter with 0.5, 0.7, whatever. I will decrease my exposure. And this is just basic risk management. Sometimes you can just be wrong. There's nothing you can do about it. You don't want to be in a position 3% exposed to the market and market just, absolutely just shits on you, falls down. You lose 3% in seconds. It's possible, isn't it? So then with these positions, again, I can pyramid them sometimes if the entries are offered nicely. And of course, sometimes they are offered and I will have, up to like 4 or 5 positions running at a time, depending on the market maker model. Off the top of my head, I had an example I sent you guys, I think at some point in October, November. Very clean trade. I will try to reply to that in the boot camp, and I pyramided about 4 positions into that and just held it till the return to origin. So that's it for the market maker models. I believe I've covered everything that you guys should need to understand them. Remember, as I started, if we just go back quickly, we go into these things step by step. A lot of these other things are, theory and understanding of what's happening behind the scenes, but the very basics are expecting that consolidation, buy side, sell side of the curve, and then the return to origin. Remember, of course, I know there's a lot of moving components, lots of things happening, but when you do get confused, just fall back to the basics and then start going deeper into the small bits when you need to. But the last thing I want to finish with is smart money tool, right? What is SMT? Now, you probably have heard other traders mention this. My question to you guys is, where do smart money participate? above old highs and lows, right? Because they need a counterparty to their orders, and that is where they get in line. I mean, everyone should agree, because that was one of the things we covered in one of the first two, algorithmic theory lessons. But let's hop in the charts. Okay, so this example is quite recent. Again, with the indices, right? This is where you see a lot of traders use SMT. Quite common. What you will notice is that they use different timings. So just, ignore my 3 kill zones. We can actually just turn these off. Now, quite interesting. This isn't how you typically, frame them, but this in itself can be a market maker buy model here. We may trade above this origin. But anyways, with Smart Money Tool, right, there's 3 stocks, or 3 stock charts, sorry. We have the US 500, we have the US 30, and we have the US 100, right? It's not the exact same, but think of it kind of like Euro USD and GBP USD. Right, we're always going to have a preference to trade one based on Euro GBP, but we can also use Smart Money Tool to discern which one is the more favorable trade. So I want you guys, I'm just going to show you and see if you notice something. This is a US 100 chart, the US 30 chart, and back to the US 500. Right, so what is different in these charts? They look pretty similar, so you have to train your eyes to see this. Let's imagine, prices created all this trend and liquidity. We've got these consolidations, and now you're like, okay, yeah, my bias is bullish. Okay, cool. So do you notice what's happened here? US 30 has swept sell-side liquidity and given a reversal. US 500, the S&P, has swept sell-side liquidity and given a reversal. However, the Nasdaq, the US 100, has not. We didn't take sell-side liquidity, we had a reversal. Now, what does this mean? It's a signature of Smart Money's participation in the other 2 markets. That means the other 2 markets are more favorable to trade. Why? The markets that Smart Money is involved in, they will give you that greater move, right? Of course, in this scenario specifically, I don't think it's the end of the world, but Smart Money Tool is something you can find on all time frames, and you can use it to discern between different pairs which one you should be trading. Like I said, you can use it on EU GU. You can use Euro GBP, of course, as I explained before, but you can also use an EU GU. It's something traders very, very commonly use in the stock markets to decide, which one should I trade today or this week, depending on a higher time frame sweep. Very important. It's small things like US 100, for example, may have swept its previous weekly high, but the other 2 pairs didn't. So which one? And imagine you're short, right? And you've just swept the previous weekly high. It makes a lot of sense to start short in the US 100 rather than the other 2. So that is pretty much how Smart Money Tool works. That is it for today's lesson. Quite a long lesson, a lot to take in there. But of course, any questions, any help you guys need, you can come to me and I'll be happy to help. If you do need to, please go over this lesson more than once. I understand when I initially learned all these things, it was a little bit confusing. But as you study and as you develop, a lot of these things will become second nature to you. As I said at the start, it's very important to know the theory. So don't slack with it. Make sure you're learning it all properly. And I'm going to be back with another lesson soon on the PD array matrix.